Today we have Joe Bondy, mortgage specialist, who was awarded 3 times as a top 1% of all mortgage specialists nationally while he was working for the RBC Bank. And he will be being in banking for more than 18 years. Today is the 1-year anniversary of your company, Dominion Lending Center's national super mortgage team. What would be the difference working in a bank and now being independent and having your own company?
Well, having the own company gives us the freedom to shop around a mortgage and find the best solution, the best products for the company. We did a great business with the banks when we worked for the banks, and we were able to know everything and anything about the 10 products that the banks offered. Now we have 38 lenders at our disposal times 10 plus products for each lender. So we have like 380 options for the clients now versus just 10. We also have lenders that, can save you on interest rate, can give you different options. We have A lenders, B lenders, C lenders. So we're not turning down anybody. We can give just about everybody an option. Whether you like that option or not is completely up to you, but we do have options for every single person out there.
Well, options are very important right now because the Bank of Canada now rates its rate 4 times since March as part of that campaign to fight inflation. And it has risen to its highest level 40 years. The next scheduled date for announcing the overnight rate target is in September 7th this year, as I read on that newsletter. So what can borrowers do to prepare?
The strategy this is the hot topic, right? I get so many phone calls now. Should I lock in? Should I stay the course on my variable rate? And I think the strategy should be, if you're going to lock in, you have to be prepared that when you lock in at a higher rate than what you're at today. So anybody, say with a $400,000 to $500,000 mortgage, is going to increase their payment by $350 to $500 a month. Probably a better strategy if you're on a variable rate would be to increase your payment by the maximum your prepayments will allow you, whether it's 10% or 15%. That way you're beating down your principal faster until the next increase comes. And if the next increase does come, you will be ahead of schedule on your amortization, paying off your mortgage faster. So you've already compensated for that increase, and it keeps you on track to pay down your mortgage versus falling behind. With all these recent rate increases, some people's amortizations went from, 25 years up to 57 years if they don't adjust their payment and compensate for this. So certain banks out there will keep your payment the same until it hits a triggering rate, where then they'll adjust your payment. Other institutions will, change every month as the rates change to make sure you're still on schedule to pay off your mortgage in the time frame that you originally planned to do so. So each individual person is its own unique situation. But right now, I probably would say, instead of taking on the higher payment and saying, hey, look at the shiny new interest I bought, because you're paying extra money for interest, increase your payments to compensate for the variable rate increases, and then keep your amortization the same. And then you get used to making that payment. And when rates come down, probably in the future, you'll end up being used to making that payment, and you'll pay off your house faster.
So this is what is happening right now. The most homeowners are changing their variable rate loan and lock it at a fixed rate.
That's correct. Yeah, like people are getting scared. They hear the stories about the 80s, when in 83, I believe it went up to a high of 23%, and they're getting nervous. There's just too much debt out there right now for the rates to go that high, unless people are going to start handing in their keys. Now, this has been in the works for the last, 4 years when the stress test was introduced. Everybody's been qualified at this, 4.79 to 5.25 rate. So the fact that the rates are actually here 4 years later from when they started this, That was foreshadowing when they put in this stress test. So everybody's can afford their house still currently. Now, do they have as much disposable income as they once did, 3, 4 years ago? No, they're not going to be buying the new sports car or the boat, or maybe they're going to stop putting that pool in their backyard, unfortunately. But at the same time, they're not going to lose their house.
Yeah, let's go back to that, what you just mentioned, that that finance is stress tested. People needs to be stress tested right now, that they can withstand higher lending rates. And last week rate hike will raise the testing bar to about 7% for fixed rate loans, right? And 6% for variable loans, which make it very difficult to qualify for mortgage.
Yeah. So since they started this spike in interest rate increases, buying power has gone down between 20 and 25%. So if you were pre-approved in March for $1 million, today you're probably pre-approved for 800 or 750, depending on what rate you choose to go with. The way they qualify you now is the stress test is 5.25, or they do 2% above the contract rate. So today, Scotiabank's rate is like 5.49. So you're now qualifying at 7.49. If you go with a variable, you can still get, say, prime minus 0.9 if you're going with an insured mortgage. That would be 3.8% as of today. So your qualifying rate would be 2% above that, 5.8. So another strategy in today's market to afford a little more would be start off with the variable. That way your qualifying rate is lower, meaning you can afford more. And then once you close it, if you really want a fixed rate, you can always flip to a fixed rate with no penalty, as long as you stay in the term that is the same or longer than what you have left. But your payment will go up by doing so.
Very hard for the first-time home buyers.
First-time home buyers are having a tough time right now. Yes. So we're seeing a lot where mom and dad are gifting down payments, if not co-signing, or siblings are buying houses together, or even, best friends are buying houses together just to get in the market, take advantage of this property appreciation. And then that way, in 2 years' time, they part ways and they've got that property appreciation and they've got a bigger down payment than if they tried to save the money themselves by themselves.
In Canada, house prices have fallen the most in areas that had the most growth early in the pandemic. Declines were strongest in Ontario and British Columbia, where buyers are most sensitive to the rise in interest rates. One labeled the hottest real estate market in the country, Windsor-Essex County, now is on the list of regions expected to see the biggest decline in home prices. But at the same time, there is a lot of projects coming into Windsor-Essex County, like Amazon Canada bringing one of the delivery stations in Windsor, new electric vehicle battery production plant, a new hospital. So what would be the bridge? Yes.
The bridge is complete. You'll see a bunch of more investment into Windsor and warehousing and trucking companies coming in. So Windsor is, I'd like to think Windsor's a little bit more isolated from, say, the GTA or the bigger cities. They'll see a bigger hit than we will. As much as they're saying, because we increase so fast, we're still affordable and cheaper than the rest of the country. Yes, as of March, I think we're down 19% from the high. But I mean, over the last 3 years, we've gone up 127%. So the 19% is a minimal decrease. And our housing prices aren't so high that, 19% is about 50 grand in difference versus in Toronto, where 19% would be almost 200 grand. Right. So it's not that big of a hit. And I mean, we're going to stabilize here. I don't think we're going to see a giant decrease. The last time we've seen interest rates go up like this was 2008, 2009. And, the economy then collapsed and then everything fell 11% back then, only to come back within a year. So this is kind of a short term, in my opinion, to get inflation under control. They're going to get it under control, but those numbers aren't going to come in for 6 to 9 months from now. And then, so next year at this time, you'll probably see rates start to decrease back to a normalized level. Will probably be somewhere in the high 4s, low 5s, I believe.
What are the changes now in business loans, investments in commercial real estate?
Right now, everything seems to have put the brakes on. Just everybody's sitting on the sidelines waiting and hoping that the market comes down so that they can get a deal. On the commercial side, at least in this market, there's very little in the light industrial. That's a very hot kind of industry, light industrial right now. We are seeing investment in this area, which is good. And that's going to bring more jobs to the area. So, and everybody's still lending, right? There's still opportunities here. So commercial is taking off. We're seeing condos in this area like we've never seen before. Some of the projects people have put on hold, but it's just a delay. It's not actually going to be eliminated, in my opinion.
It's a lot of things that it's a building right now in Windsor, Essex. It's totally different area than the other parts of Canada. That's very true. You know, even if some say that Canada is going through a recession right now, it's still Windsor, Essex is like holding.
Well, we're definitely feeling it on the real estate side. Like for the last, say 3 months, things have slowed right down. Okay. But usually in a normal market, what happens is every time there's a rate increase, there's like a 2-week lag before the clients get accustomed to it and then get back into the market. Well, for the last 3 months, there's been a rate increase one way or another every 2 weeks for the last 3 months. So that's why the market has slowed up here, and we're just waiting for things to stop. So you said September 7th was the next Bank of Canada meeting. I believe since they did a full percent, I'm hoping they don't do any increase in September and wait till the following meeting after that, which I believe is the end of October. If they're going to do any more increases, give the people some breathing room right now. Let them get accustomed to this new normal, which is, a substantial increase in the rates that they've done. Like I just looked at a graph the other day, and, you've seen rates go, slowly down to the bottom. And then within the last 3 months, straight up, like a direct, arrow straight in the air to where rates were 20 years ago when I got into this business. So we should stay optimistic, considering all the projects that are coming, and maybe those rates will not go higher in September. So I hope not, to be honest. But I mean, I don't have a crystal ball, so I can't see. But I do believe they will start coming down middle of next year, because we'll be coming into an election year. And usually rates do come down in election years. So they'll probably want to bring rates down and earn favor with the population for the election. Is there anything else that it's important for you that you think that's need to be stressed out, considering the situation with the high rates and mortgages at this moment? So, I mean, the interest rates are personal preference. When we qualify you at 2% above your current rate. So we make sure you're going to afford this house. We're not putting you in a house that you can't afford. So I wouldn't worry too much about losing your house if I was a client out there. But at the same time, there's some strategies, like I was saying earlier, maybe go with variable. And when the rates come down in the next year or so, then you can consider locking in, instead of locking in and paying a premium over the next 5 years. So that would kind of be my 2 cents right now. So, okay. Well, thank you very much for all the insights for today. And I wish you all the best. Thank you so much. Thank you. Appreciate it. Bye now.